In this lesson, we're going to explore how to use the MACD indicator like a professional trader, and I'll reveal several advanced techniques that you won't find anywhere else. Throughout this tutorial, we'll cover everything you need to know about MACD and how to apply it effectively in real market conditions. But before we get started, if you'd like us to continue creating free educational content like this, we need your support. So please take a second to hit the like button and subscribe to the channel. All right, let's dive into MACD. MACD stands for Moving Average Convergence Divergence. In simple terms, the MACD indicator measures the relationship between two moving averages, a fast-moving average and a slow-moving average. To keep things simple, we can use MACD to evaluate and confirm potential trend reversals, as well as trend continuation opportunities. To add the MACD indicator to your chart, go to the Indicator section, type MACD, and select Moving Average Convergence Divergence. Once you click on it, the indicator will appear in the lower panel of your chart. Leave the settings at their default values. The blue line is the MACD line, which represents the faster component, while the orange line is the signal line, representing the slower component, and these bars in the middle are called the MACD histogram. Now, before we go any further, there's one very important point you need to understand about indicators. Indicators are not magic. There is no such thing as a magic indicator that can tell you exactly when to buy or sell. We never use indicators alone to enter a trade. Instead, we use them to confirm what we've already identified through price action analysis and to improve the quality of an already good trading opportunity. So, with that in mind, let's take a look at how the MACD indicator is traditionally used in trading. The first traditional way traders use the MACD indicator is through the crossover strategy. Let's say the market is currently moving lower. When the MACD line crosses above the signal line, many traders consider this a bullish signal and a potential indication that the trend may be reversing. When the MACD line crosses above the signal line, traders interpret this as a potential shift from a bearish trend to a bullish trend, suggesting that buying opportunities may start to emerge in the market. On the other hand, when the market is moving higher and the MACD line crosses below the signal line, this indicates a potential shift in the trend from bullish to bearish. In other words, it may signal potential selling opportunities in the market. Now, the second traditional way traders use the MACD indicator is by analyzing the histogram. In an uptrend, when you see the histogram bars getting larger and larger, this indicates increasing momentum, or in other words, that the market is gaining strength and fuel to continue moving higher. This can be used to identify potential trend continuation buying opportunities. However, when you notice that the histogram bars start getting smaller, it indicates that momentum is weakening, or in other words, that the market is losing strength. This may lead to a trend reversal from bullish to bearish and can create potential reversal trading opportunities. Now, in the opposite direction, during a downtrend, when you see the histogram bars getting larger and larger, it indicates increasing bearish momentum. This can be used to identify potential trend continuation selling opportunities. However, once you notice that the histogram bars start getting smaller, it suggests that bearish momentum is weakening. This may lead to a trend reversal from bearish to bullish and create potential reversal trading opportunities. So, it's clear that there's nothing inherently wrong with using the MACD indicator in these traditional ways. Which method works best ultimately depends on your overall trading strategy and personal preference. However, the reason we personally don't use MACD in these traditional ways is that we've found these signals are often lagging. More importantly, as price action traders, we believe that price itself tells us exactly what the market is doing in real time. By reading price action directly, you can see what's happening as it unfolds, rather than reacting to delayed signals. But this leads us to a question that we're asked all the time. How should the MACD indicator actually be used to make it effective in price action trading? To answer that question, one of the most effective ways to use the MACD indicator is through divergence analysis. So let's dive into it. This is the anatomy of a bearish divergence in an uptrend. The price creates a higher high, while the MACD indicator forms a lower high. This creates a divergence between price and the MACD indicator. Now, let's take a look at this on the chart. Once again, the price creates a higher high, while the MACD indicator creates a lower high. This divergence signals weakening momentum and can often lead to a trend reversal. Now, from a price action perspective, what does divergence in an uptrend actually tell us? divergence can act as an early warning signal of a potential trend reversal from bullish to bearish. More specifically, it can help us identify potential selling opportunities in the market. Now, let's look at the anatomy of divergence in a downtrend. In this case, the price creates a lower low, while the MACD indicator forms a higher low. This creates a divergence between price and the MACD indicator. Let's take a look at this on the chart. Once again, the price creates a lower low, while the MACD indicator creates a higher low. This divergence signals weakening bearish momentum and can often lead to a trend reversal. Now, from a price action perspective, what does divergence in a downtrend tell us? Divergence can act as an early warning signal of a potential trend reversal from bearish to bullish. More specifically, it can help us identify potential buying opportunities in the market. One important point: although we're using the MACD indicator to explain the concept of divergence, all of the divergence techniques and strategies we'll cover in this video can also be applied to other indicators, such as RSI, stochastic, and many other momentum indicators that display divergence. In other words, you can easily replace the MACD indicator with RSI or stochastic and apply the exact same concepts and trading principles. So, divergence is an incredibly powerful tool. However, like everything else in trading, using it on its own is not enough. Sometimes you'll spot what looks like a perfect divergence setup, just like this one here. But what happens next? The price makes a small pullback, fails to reverse, and then continues in the original direction of the trend. This is what traders refer to as a fake out. To avoid this problem, you should always combine divergence with some form of trend reversal confirmation. Let's take a look at what that means. So here's the confirmation formula. First, identify your divergence. Then, after the divergence has formed, look for any type of price action that confirms a potential trend reversal. This helps confirm that the divergence is genuine and not simply a fake out. Let's look at an example on the chart. Here, we have a downtrend. The price initially formed a divergence, but this is what we call an unconfirmed divergence. Why? Because after the divergence formed, there was no confirmation of a trend reversal. As a result, the price made a small pullback and then continued moving lower. For a genuine reversal, we would need to see something like a higher high, a higher low, or any other price action pattern that signals a change in trend. Later, the price formed a second divergence, and this one was confirmed. Once again, after the divergence forms, you're looking for any type of price action that confirms a potential shift from a bearish trend to a bullish trend. And in this case, that's exactly what happened. First, you could identify this bullish reversal pattern, a falling wedge that had formed on the chart. Then, when the price broke above the pattern and moved above the trend line, it confirmed both the divergence and the reversal pattern, signaling a trend change from bearish to bullish. The second confirmation of the trend reversal came from identifying a change in market structure. Let's take a look at a classic trend reversal structure. First, the market forms a lower high and a lower low. Then, it creates a higher high. This shift in market structure confirms a potential trend reversal and, once again, validates the divergence signal that warned us of a possible transition from a bearish trend to a bullish trend. Once the trend reversal has been confirmed, you should move to lower timeframes and look for potential long entry opportunities. Now, you might be wondering, why look for divergence first instead of simply waiting for the trend reversal itself? This is where divergence becomes especially powerful. First, divergence gives you an early warning that a potential trend reversal may be developing before the actual reversal takes place. Second, when divergence is combined with price action that confirms a trend reversal, it often leads to a very high-quality reversal setup. In other words, there's a much greater probability that the market will not only produce a small pullback, but will actually reverse and move with strong momentum. And of course, the further the market moves in your favor, the greater the potential profit from the trade. And that's where we'll stop for part 1 of our MACD series. In this video, we covered what the MACD indicator is, why we don't use it in the traditional way, and how divergence can help us identify high probability trading opportunities. In part 2, we'll dive deeper into advanced MACD divergence strategies, multi-timeframe setups, and real market examples. If you found this video helpful, don't forget to like, subscribe, and let us know your favorite trading indicator in the comments below. Thank you for watching, and we'll see you in part 2.